record again. Okay, depreciations under historical cost. And this is quite straightforward to you, right? You have done this a lot in 2100 in the first introductory financial accounting course. So it's a system process of cost allocation, right? You are going to allocate the cost of the asset over its economic useful life, right? You are matching, basically you are honoring matching principles. You match the cost with the revenue, okay? Then you have to make some assumptions, use your professional judgment in terms of the pattern of depreciation, right? Straight line, declining balance, units of production, useful life. What is the amount of useful life for a building, right? You have to make some estimate assumptions that requires professional judgment. There are some other kind of terms that are similar. You use depletion, amortization, but there are still some differences here. Depreciation refers to tangible human-made assets. Depletion refers to tangible natural resources. If you're talking about the mining site, right? Mining site. So that you use depletion, right? Amortization refers to intangible assets, right? Softwares, patent, right? Those kind of things. When you're talking about tangible asset, we use depreciation, okay? So there's some kind of subtle distinguishment among the three terms. I don't want to talk more about this because you know this. What's depreciable amount? What's the depreciable amount, right? So the total amount to be expensed, okay, which is the initial cost less than residual value, right? Less than residual value, okay? And what is the residual value? That's the estimated amount asset will currently obtain from disposal of the asset, okay? After deducting the estimate cost of disposal, okay? If the asset were already of the age and in the condition expected at the end of its useful life. So you know what's residual value, what's the depreciable amount, right? And then the patterns of the depreciation. Basically, you are saying what's the pattern of revenue earning? If the asset earns revenue evenly over the useful life, okay, then you use a straight line amortization. If the asset generate lots of revenues in the early years, okay, then the amount of revenue generated declines. You use declining balance amortization, right? The examples would be the computers, right, equipment, and units productions in terms of certain equipment, right? Tractors, working haul trucks stuff. They are based on mileage, right, or based on machine hours stuff, right? So they have their useful life is based on the estimated the amount of machine hours mileages available, right? And so then you use that as a way to amortize, right? Depreciate. So in terms of the useful life, what do you mean by useful life, right? Useful life is the period of time over which an asset is expected to be available for use by an entity, okay? Rather than actually use. You can say, actually I only use this asset for 5 years. I should, instead of using 10 years, the useful life, I should use 5 years because I only use this asset for 5 years. No. It has nothing to do with how many years you actually use it. It is really about how many years this asset is available in use. Does that make sense? Okay. So you buy a piano, okay? We have a piano, but right now nobody uses it, okay? So, you want to say, the amortization would be 1 year, right? The useful life is only 1 year because I haven't used it so far. I'm only going to use it for 1 year, right? The number of the useful life is not depending on how many years you use it. The the piano is still good for use. It can be used for 10 years, 20 years, 30 years, right? So, so make sure you distinguish between that, right? The actual use versus available for use. Okay, so again, these are the things you're already familiar with. That's why, you know, I'm just quickly go through this. Does anyone have a question?
No.
No? Okay. Okay, you know, just for my benefit, okay, just I want to take a look here. I want to see, okay. Okay, can anyone, okay, how many people we have on? We have 26, okay. Okay, if I count 1, 2, 3, please sum up. I want to see how many people is listening to me. Okay, 1, 2, 3, sum up. 1, 2, 3, 4, 5, 6, 7, 7. Okay, thank you.
How do you thumbs up?
I'm just doing an experiment because I'm just trying to see, like, you know, sometimes people is in the class, right? But they may not pay attention, right? So I'm just using that as an opportunity to see, you know, we are, what time is it now? It's already like 8:10. So I just want to see the level of attention now. Okay, so I'm going to move on. Okay, I'm going to move on. Other considerations, partial year depreciation, right? Remember, when you sell your asset, right, in the middle of the year, you have to first update cumulative depreciation. Don't forget the partial year's depreciation, right? Because the cumulative depreciation balance was based on the ending as of the previous year end, right? And there are already some months, you know, elapsed in the current year. Don't forget, you have to update your depreciation, right? So the partial year depreciation. And also, not all depreciation expenses goes to income statement, right? For example, the factory, right? You remember the overhead, right, for the manufacturing company. Some of the overhead is about depreciation on the factories, right? So those will become part, if it's if it's absorption costing, those fixed, a partial of the fixed cost will be absorbed in the inventory, right? So some of the depreciation expenses can end up on the balance sheet in the form of inventory, okay? Just keep that in mind. So not all depreciation expenses flush through income statement, right? So just knowing that.
So I have a quick question about that. So if it's incorporated into inventory, like the depreciation is incorporated into inventory, how would you know it's incorporated? Like, would there
So basically,
be a note
in
or
those
something?
companies, they would calculate what's their manufacturing overhead, right? Depreciation expenses on factories, that anything related to the manufacturing will be part of that overhead. And that's included in the working in progress, right? In the inventory.
Okay, thank you.
Yeah. Okay, so here's one example. Again, the calculations you have done in the 2100. So in this question, okay, McKinsey company example. So company purchased a piece of production equipment for 120,000 to replace an identical machine that has reached the end of its useful life. The equipment has an estimated useful life of 5 years. In terms of units production, company expects useful life to be 1,000 units. Its residual value is 20,000. It's used 40% rate for the declining balance method of depreciation, right? So let's take a look at the calculation. Straight line over 5 years, okay? So you calculate what's your depreciable amount. Use your cost, 120,000, minus your residual value, 20,000. Your depreciable amount is the difference, 100,000. And the useful life is 5 years. So you divide it by 5. Every year you recognize 20, right? Every year 20 for the straight line amortization, right? Pretty clear, right? And then the carrying amount will decrease from 120 to 20, right? Because at the end of the 5th year, your value should be the residual value 20. And initially you have 120. So you can see the carrying amount decreasing by 20 every year. Every year, this balance decreasing by 20, right? The carrying amount. Clear, right? You have done this calculation before in 2100. Declining balance, okay? Declining balance, you do not use residual value, okay? That's the difference. For declining balance, you do not use residual value. So you use your initial cost, 120,000 times the rate, 40%. So you get 48, okay? You get 48, okay? So your carrying amount will be decreased by 48. So 120 minus 48, you are left with 72, okay? So next year, you are going to use 72. That's opening balance, carrying amount, times 40%. And that is your 28.8 amortization, okay? And so then you just keep doing this, okay? And this balance declining until it reached 20, right? That's your residual value. So at that point, you should not depreciate any further, right? You should not depreciate any further. So the last year depreciates 0 because you already reached 20, okay? Units production, okay, depending on the units of production. So total units is 1,000. So the first year you have production of 15. That means the percentage of depreciation should be 15%. Okay, 15% times the 100,000, right? Is that right? How did they get 15? How did they get 15? Okay, so the units of production, the company expected useful life to be 1,000 units. Okay, so I think there are more information that was not on this table. So they have to tell us what's the amount of the units. Okay, what's the amount of the units?
That's like the actual units that they actually, it's not an estimate, it's just an actual
This is the actual units? No, I thought this is the amortization.
Oh.
Yeah. But you know how to do the units of production, right? You calculate the percentage of the usage, right? So the number of units used for the year divided by the total expected units, right? 1,000 in this case, right? And that's how you do the amortization. Okay. So again, this is something you have done. Like I taught 2100. I know we have done a lot of this. I don't want to waste time, beating this horse to death. Okay. Okay. So impact of changes in estimate on the depreciation.